Hello, everyone. Connor Lokar, Senior Forecaster with ITR, checking in for another edition of Trends Talk. Today, we noticed that interest rates are on the rise here in 2022, with the long bonds being 10-year Treasury yields moving higher early 2022. Right now, at the time of this recording, sitting near 2%. Short-term rates are soon to follow as the Federal Reserve begins a tightening path this year, and another important rate is on the rise as well, that being mortgage rates. Now, mortgage rates tend to track directionally with 10-year Treasury yields, both of which have been rising generally since bottoming out at various points in 2020. 10-year Treasury yields bottoming out mid-2020, mortgage rates bottoming out late 2020. Now, the contract rate on 30-year fixed rate conventional home mortgages averaged 3.76% nationally in February, and that's up more than 100 basis points since its late 2020 low near 2.7%. Now, even more recently, some spot rates in March are showing mortgage rates north of 4%, and this is causing a little bit of concern. Now, this is worth watching, but rise in nominal rates of this magnitude is so far insufficient to break the housing market. Bending the rate of growth, sure, but not a full market breakdown. Now, ITR has been forecasting a housing market slowdown in 2022 for quite a while now. 2020 and 2021 were exceptional years for housing, as the housing market really capitalized on falling mortgage rates, elevated disposable income and savings trends, bullish returns in the stock market, and what I'll call those COVID quirks, being those harder to quantify factors like work from home trends, exodus of some folks in 2020 and 2021 from cities into rural or suburban markets, becoming homeowners, all of which awesome for housing. Now, basically, all those factors are in less favorable positions now than a year ago. Disposable income and savings trends are normalizing back towards their longer term trends, as we're now essentially a full year removed from that last burst of fiscal stimulus in March 2021. The stock market has been moving lower as of late. Inflation is significantly higher, pressuring the consumer. And yes, of course, mortgage rates are up. Now, all of these portend a somewhat dampened home buying environment here in 2022 compared to the red, scorching hot market of the last couple of years. We are observing rate of change decline in new and existing home sales, so clearly that pressure is real so far in 2022, and we're seeing that housing starts are also decelerating on the development side of things. So yes, mortgage rates going up, it's one of several factors that's yielding a slowing growth environment for residential markets in 2022, but it's hardly the only factor. What we've seen so far from mortgages points to bending growth rates, but not a full-fledged housing market breakdown. ITR has identified a breaking threshold, really is closer to 300 basis points in terms of interest rate increases, whether that's short, long-term rates, and of course the mortgage rate as well. So we're pretty far from that threshold in terms of causing material damage to the economy or the housing market, and we have quite a ways to go before we get to that point. So we'll keep an eye on it, of course. But so far, so good in that regard. So thanks for listening. We'll see you on the next one.